Hello and welcome everyone to our panel session today, looking at hedge fund by design, constructing the product of the future. And we've got a great panel this afternoon, or this morning, wherever you are, to look at this. My name is Tom James from TradeFlow Capital. I'm over on the other side of the world in Singapore. We have Rom Lee with us, John Delano and Anne-Marie Fink on the panel today, and get them to introduce themselves. Starting with you, Rom.
Hi, I'm Rom Lee. I run a firm called Seven Bridges. Prior to running Seven Bridges, I was at two large endowments. Seven Bridges mostly runs money for taxable families. We also do some endowments across all assets. Of the $6 billion that we manage, about 40% of it is in alternatives. Because my prior career was in endowments, I'm used to doing both non-taxable money and taxable money.
Thank you very much. And John.
Hey, everybody. My name is John Delano. I'm the head of research and analytics at Commonfund. We're an asset manager and OCIO for nonprofits and primarily endowment and foundation clients. So very much in that sort of CPI plus 5 discipline.
That's great. Thank you. Anne-Marie.
Hi, I'm Anne-Marie Fink, and I'm with the State of Wisconsin Investment Board. So we're a public pension plan in the U.S. We have about 140 billion in assets, and then I manage our group that manages our external investments. So we have about 65 billion with third-party managers, of which about 6 billion, 6.5 is with hedge funds. And prior to working here, I worked at another state plan and then started my career at JP Morgan.
That's great. Thank you so much. Well, it's lovely to have you all on the panel today. And well, it's a good mix. I mean, we've got people, different size, shapes, asset classes, different types of investment angles. So it should be very interesting. So to get right into it, I mean, looking at the new sort of portfolio, etc. I mean, what do we mean now by the term hedge fund? So I mean, how are you defining that in your programs and your portfolios? Let's start with Anne-Marie, if you.
So we actually have a very specific strategy behind our hedge funds, which is we have a portable alpha construct. So we actually, as a result, use very low beta hedge funds, and then we pair those with betas that we get through basically through passive allocations, so to equities and fixed income. So as a result, we're really looking for people that can give us idiosyncratic and alpha, right? And so that actually, it's an interesting construct because it means there's a whole bunch of funds that we can say sort of at the beginning, that's just not a fit for us. And we also like it because we feel like that way we're only paying really for the special sauce and not so much for high fees for things that we can get elsewhere more economically.
Okay, that's great. Thank you. Rom, what do you...
We really have two kinds of hedge funds in our mind. I mean, there's one that is really meant to just try to diversify us away from equity. Most portfolios, the major risk they have is equity risk. And in the US, it's mostly US equity risk. So in a sense, it's sort of a bond alternative. If rates were different, we might have less in alternatives and more in bonds. Part of the reason we're so high in alternatives is that bonds seem so unattractive to us. So that's one kind of hedge fund that actually is kind of a true hedge fund. It actually, and then we also have investments in hedge funds that really aren't lower volatility than equities, but they have a very different path. And that's really more the hedge funds, and that's a lot more, long short funds, not the market, not the market neutral funds. And in a sense, those are really less constrained because they can go long and short and do different things. And they're really compensation structures for unconstrained managers, which is different than the bond alternative ones. And so for those, they're still generally taking some equity risk, but we saw it in the first quarter of 2020 where the markets were down a lot. And those managers, those unconstrained compensation structure managers, really did quite well versus the markets. But overall, their vol and even their drawdown isn't that in the markets. I mean, their drawdown is less, but the vol is not that much less, but they tend to do it in a very different pattern. So I think of the kind of hedge funds we have in those two categories.
Right. So yes, hedge fund that actually does hedge some of your income and revenue. So yeah. John. Oh, you're on mute. I think that must
Sorry
be
about that.
Famous phrase for the last year and a half.
Yeah,
You're on mute.
Right. Well, thanks for that. In terms of definitions and extending to the role in the portfolio, to us philosophically, a hedge fund is something that uses long-short discipline rigorously to generate return, and consequently, the return that they do generate is different from not just the so-called beta factors you get in the rest of the portfolio, but also the types of alphas you might get from, say, a long-only stock picker. And so that long-short discipline, typically with emphasis on the short side, want to see something delivered on the short side, is definitionally what we're looking for. And in terms of how that boils up into the portfolio and the portfolio role, it's just that philosophically similar to what Anne-Marie said. We are looking for differentiated return that delivers a source of return that is not elsewhere in the portfolio, quite simply, and that justifies the fees, where we're careful about what we're paying and how in a measured way, and earns its place in the portfolio that way.
Thank you very much. That's great. So what is the role? And you've certainly you've all alluded to it in your responses, but what are the role of the hedge funds specifically in a portfolio generally? I mean, obviously trying to balance out the portfolio, that's one thing, but perhaps Ron, do you have some further comments on that?
Yeah, the main role is, in my view, is really to dampen volatility overall, and specifically to dampen drawdown. We really don't care about volatility. People don't care about upside vol. We really think about risk as drawdown. I mean, people historically did efficient frontiers, volatility versus return. We do them that way, but we also do them drawdown versus return, because drawdown is really how we think about risk. And so I think if an investor really doesn't care about drawdown at all, then there's a pretty small role for hedge funds, I think, in a sense. Because that's really, it's a lot of complication, it's a lot of leverage, it's a lot of stuff going on. If you don't care if your portfolio is down 30% in a 12-month period or 40%, then I think the role of hedge funds gets pretty small. But so that's really ultimately you have to decide. And it's interesting because you look at the first quarter of 2020, we've had this discussion with clients. People say, okay, well, market's down 20, I'm not so worried, but that's because we had a huge V snapback. I mean, in general, we've had pretty strong snapbacks when we've had downturns. If we didn't have that, it was down 20, and then it was down another 20, and then it was down another 10, people might feel differently. I feel like people look at the most recent drawdown and they go, oh, that's not so bad. They would have felt differently if it was down 20, down 20.
Exactly. You start feeling like a retail investor, and it's 2020, and then it's 10. It's like, oh, okay. Anne-Marie, what are you looking at there in terms of the fundamental role in a portfolio?
Yeah. So for us, it's really it's sort of similar to what Ram described in terms of the kind of fixed income, in a way, replacement. We're just looking for returns that are different from the returns that we get in a lot of our portfolio from fixed income or equity. As noted, equity risk is probably the biggest risk in our portfolio. So we're looking for a differentiated return stream that can help dampen volatility or help dampen drawdowns when they happen and give us that extra return on top of really at least in this part of our portfolio, on top of those passive allocations that we have.
Right. Thank you. John?
And I'm glad both Ram and Anne-Marie mentioned drawdown as a key risk factor, because to us, and especially in terms of relative to the old efficient frontier, I think when you choose what to optimize to and you really think about what is the hazard for, especially in our space, an endowment and foundation investor, it is drawdown. It's that unrecovered drawdown that materially has an impact on spend. And so when we think about hedge funds and the role in the portfolio, it's really about that. Is how do we best cut off those drawdowns, put ourselves in the best position to manage them, and ideally shorten the recoveries as much as possible. And so more broadly, when we think about what specifically the hedge fund portfolio should look like and what the underlying return drivers should be, it's just that. It's the returns that the really simple phrase, returns you don't get in the rest of the portfolio, turns out to be quite a discipline to adhere to, because most hedge funds are driven mostly by factors that are in the rest of the portfolio, primarily equity risk, as both the other panelists mentioned. And so that discipline of stripping that out and really targeting that alpha that hedge funds can uniquely deliver is really the key for in that portfolio role of minimizing the drawdowns and delivering the uncorrelated return. And so a lot of those return drivers can be cataloged and so forth, and we can get a pretty good idea of how we expect them to behave in different environments, different market environments, different drawdown scenarios. But that's the key for construction and what we're targeting for the role of the hedge funds in the broader portfolio.
And Tom, one thing I would say about drawdown is most of the money I'm managing now is taxable, but when you have an institution that has a fixed spending rate or almost a fixed spending rate, the endowments I was at didn't actually have a fixed spending rate like the university endowments don't, but they practically do. The foundations have to spend 5, endowments spend roughly 5. When you have a fixed spending rate, drawdown really makes a difference. When you have big drawdowns, because you generally have to spend based on the 3-year average of your assets. And so when you have a drawdown in 1 year, you're spending 5%, let's say, based on the 3-year average. So you're spending a lot when you're down. And so if you model it out, having less drawdown actually allows you can actually have a slightly lower return overall if you have less drawdown because you have a fixed spending rate. You actually wind up being able to spend more over time if you limit drawdown, if you have a fixed spending rate.
Right. I mean, the thing is I guess it brings us on to sort of the other question of how, given, spending rates, given different interests, different needs for different types of investors. I mean, how do you align interests between the hedge fund manager and yourselves? I mean, Anne-Marie, question there. I mean, what do you look for, to ensure you're paying fair fees, the right kind of incentives to make sure you're getting the right sort of performance from your managers?
Yeah, we look at a number of things. I would say one, so we certainly want to see alignment of interest, right? That the way the compensation is set up is such that we want our hedge fund managers to get really wealthy, but we want them to only do it if our pensioners are making a lot of money too. And so one of the disciplines that we do is we actually calculate gross returns and net returns, and we're looking to make sure that at least 60% of the gross returns end up in our pockets. And you'd be surprised sometimes it doesn't quite get there. So that's one thing that we do, and then we're always looking for different ways to make things a little bit more even. I would say, so I also, within my remit, we also do long onlys. And so we've done, I would say, a little bit more creativity with the long onlys, because there we do have some data. So there we'll have some hurdle rates, we'll have some benchmarks that we use. because our hedge fund book is largely beta free, largely, that doesn't make as much sense there. One of the things that we are starting to explore though right now is co-investments. So we've done a lot of co-investments in our private equity book. It's a pretty established thing. And we're starting to dabble with it in our hedge fund book, both because we're building the expertise internally to do it. And also we're finding the managers are coming to us and starting to say, we have this trade where we've got a little bit of extra capacity. We don't want to overweight it within our larger fund. What do you think? And for us, within, our full fund, even an overweight that is too much for a particular fund is not that meaningful. And so we are starting to look at some of that and build that out a little bit.
Oh, very, very interesting as well. So, no incentives for for fund managers, extra incentives to do the V-shaped recovery. I guess that might promote doubling up sometimes.
Yeah, certainly we want recoveries, and we actually have a pretty again, because our hedge fund beta is our capital is kind of ported on top of our larger fund. One of the things that we can do, and we actually have a pretty elastic amount that we can put into hedge funds. And so one of the things that we really benefited from last year is we put a fair amount of money to work in the second and third quarter of last year. So we did capture a little bit of that recovery. To Ram's point earlier, it happened a little faster than we expected. So we were planning to pace out the allocations over the course of 2020, second, third, and fourth quarter. And by the fourth quarter, the stuff that we were planning to do, it was sort of too late.
Yeah. Great. John, you mentioned about alpha and beta earlier on. I mean, do you have any sort of comments on what's termed smart beta and factor some of these things into your
I do, and it's quite aligned to again Anne-Marie's comments on fees and how critically important that is, and how we think about alpha beta separation. And just to comment that the 2 and 20 fee structure, and plus minus a few points on either side, has lasted a really long time. And not only are those suspiciously round numbers and very unlike any other financial asset that trades in the market and has very important consequences for net return, but they haven't changed in a really long time. And that gives an opportunity, when you asked about smart beta, when it comes down to separating the alpha and the beta, increasingly it's all about alpha is what is the most cost-effective way to access that return without that performance fee, ideally. And if in an environment like we're in, where the S&P, I think it's up 30 on trailing 12, so forth, and that's been higher than that for most periods, paying 20% carry on that factor, if it's not separated, is hugely consequential to that net return. And so really targeting, when we talk about alpha and beta, I think you asked about smart beta and so forth. Once upon a time, this exercise of separating which is which and what we're going to pay the hedge fund fee for and what we're not was about the FAMA French factors or so forth, or a kind of a small handful of well-known patterns in markets. It's expanded monumentally since then. And part of it is just the presence, an explosion really, of smart beta or similar product systematic strategies that you can access through, whether through banks or through funds or so forth, with low fees, with no carry. That's the alpha ultimately that you're looking for. It's what is the most cost-effective way to deliver this return that you're targeting for the portfolio. And the better you can get a very specific peer comparison, the more precise you can be with what constitutes alpha and what are these betas you're intentionally allocating to, the closer that hedge fund portfolio gets to, again, by design, I think is the title of the panel, but closer to performing the way you expect it to in different environments.
Yep. No, that's great. Thank you so much. Rom, over to you. Unfortunately, under less exciting things that both hedge fund managers and investors hate, lockups. What do you think about those, and what can we do? I mean, there's been a few of those, unfortunately, last year, and sometimes they were for the right reasons, of course. But
the lockups sometimes are an alignment of interest if the strategy actually needs it. The problem is more and more the hard access managers are just, they have what I call business lockups, not strategy lockups. They just get them because they can. It's not, the strategy doesn't need it. And so one of the things that I always counsel managers to, particularly when they're starting out, is that these very long lockups or these very long investor level gates where it takes a long time to get out, you really force investors to make the decision to get out maybe earlier than they want to. If you're going through some sort of a fallow period for alpha or whatever it is, and then the manager, if you're the LP and you're going to the hedge fund manager and you're paying them they have a call option, right? That's always the issue with the alignment of interest is that they have a call option on your performance. If they lose money, they don't give me any money. They don't share in the pain, they just share in the gain. So, there's always that misalignment there. So therefore, when they're going through that fallow period, which is hopefully just a fallow period and not like a degradation of alpha, you do sometimes as an LP have to think about whether you're going to, if it takes a long time to get out, you sort of say to them, hey, I have to make the decision now because I'm still going to be invested with you for the next 2 years or sometimes even 3 years. So I do think that sometimes these lockups wind up being counterproductive in terms of what the managers are actually trying to achieve. When I was at Howard Hughes, which is about a $20 billion fund, we had a lot of separate accounts, and people would worry with hedge funds, and people would worry that we were going to take the money at the worst time. The truth is, because we could take it at any time, we actually didn't we didn't take money from our separate accounts in 08. We didn't take it because we could take it at any time, whereas someone who gives you maybe once a year to get out or whatever it is, you're like, all right, I have to take it now if I think I might want it.
To interject, I mean, that's a very interesting comment. I've heard that a lot from investors I deal with, where everyone wants to have like super liquidity, like take it out any time, but actually is something that they like to have. It's a comfort, but rarely will people actually just completely pull the plug, unless things are going horribly wrong. Yeah.
I mean, obviously, as a manager, you have to think about who your LPs are. You have to think about, HHMI is and most of the endowments are known as, they don't tend to be fast money. So, it kind of depends. And, the pensions don't tend to be fast money. So you have to think about who it is. But the one thing I was going to touch on that John was talking about, that separating the alpha from the beta, one of the first questions we always ask when we look at a hedge fund, and like a lot of long short funds, who have some, residual beta, they're 30 to 50% net long. But even aside from that, if you look at a lot of the funds that did well over the past 5 years, if you were just long tech and consumer discretionary and you were short retail and staples, that was kind of their trade. So, it may not get teased, it may or may not get teased out if you look at the factors, but I always think in, replication terms. I always meet with a manager and say, can I just replicate this return stream? Even if I can't tease it out from quantitatively, I can just say, this is kind of what they do. And am I basically just getting this mix of factors or this mix of betas, to sort of John's point, long and short? And that's kind of what I'm getting. That's always the first question. I started in this business working for Narv Narvekar, who runs the Harvard Endowment now, and Lana Zimmerman, who ran HHMI. They were both derivatives guys a long time ago. So I was trained by derivatives guys to always think in replication terms. And so that's one of the first questions we always ask.
And can I just add to Rom's point?
Yes.
And I love the point about derivative returns and replication, because that's step one. When a prospect manager comes in, or even before that first interview, that's step one. Can you replicate it? And if you can, what conclusions can you draw from it? And that really informs that conversation. The managers often find it interesting too, to see on a comparison, what set basket of instruments could deliver that return, and therefore represents their investment process in a sense, or implicitly. And that's really importantly, though, a lot of these factors, if you want to call them, are not factors at all, right? I think in the literature, there's quite a heated debate about what's the premium about small cap and value and so forth, and really small number of what are, again, known as canonical factors. But if you're talking about a hedge fund and replicating it, a lot of the largely derivative-based series that will act as effective replicators that you can't access without fee, they aren't canonical factors. They're simply processes. They're systematic trades, if you will. And so that's a really important part of, it's not just factor alpha, it's comparison of cost. What is the most cost-effective way to deliver this return series?
Yes, I mean, Anne-Marie, do you also do you have any comment on that as well? I mean, I guess there's so many ETFs and indexes now that we can just go long, which are pretty cost-effective to get in. I guess it's harder for fund managers as well now, and they know that they've got to be able to beat this sort of cost.
Yeah, for sure. And, when we're doing analysis on new funds or our current funds, we do spend a lot of time looking at the basic betas, the sort of more style or alternative betas. And then we're really looking for people who ultimately have idiosyncratic returns or returns that we can't explain in any other way. And so we do spend a lot of time looking at that. And to the point my co-panelist raised as well, we also want to do our own analysis on where we think returns are coming from, and then have conversations with managers to see how conscious they are of some of the returns that they're making, and that they are focused on where they're actually taking risk and not kind of thinking they're doing bottom up, but really, to Ram's point, they're doing, a bunch of sector overweights and underweights. So that's another thing that we try to spend some time on. We're also looking, I would say, at different strategies. So we do long short, and as mentioned earlier, we tend to do sort of market neutral-ish long short, but we also spend a lot of time in the relative value space in macro.
I mean, that's in fact was a question I had, Anne-Marie, was actually sort of what strategies and regions are you spending more time on at the moment? And we can perhaps have a discussion on that.
Yeah, so we are doing, so like I said, we have a pretty diversified portfolio across different hedge fund strategies, relative value, long short, a lot of some multi-strats, some macro. The one thing I would say that we've been doing recently is going a little bit out, actually a little bit contrary to what Ram was saying, a little bit out on the liquidity curve. So we've been doing some funds that are sort of like a 1 year investment period, 3 year harvest. And we're finding some interesting opportunities that are a little bit longer dated, mostly fixed income or structured type opportunities, but that aren't so long that we have a separate bucket where we put basically private debt funds, but those tend to be kind of 3 year investments and 5 year harvests. And we're finding some interesting things that aren't quite fully liquid, but aren't quite the return and liquidity profile of our private debt. And so that's one area that we've been focused on recently.
That's great. I mean, and the same question to you, Rom. What are you sort of looking at and where? I mean, we're in the post-COVID world, and seen a lot of shakeups. I think a lot of lessons learned as well.
Well, I mean, one of the things, this isn't really COVID related, but given what happened in January, since we're talking about hedge funds, there was a real spotlight was shined on the risk of shorting in January, right? And so people always knew that, shorting has, what's the most that, you can lose in a short? Infinity. I mean, sort of, they can just go forever, right? So, it's different than a long. A long problem becomes smaller, a short problem becomes bigger. Everyone's always known this. And people used to manage this risk by size. They used to say, okay, I mean, I might have a long that's 8%, but I won't have a short that's more than 2 or 3. And we used to think that the risk of shorting a crummy small cap company was that someone comes along and pays 100% premium for it. Maybe someone tops that by 50%. And okay, I mean, it's bad. You lose 2 or 3% in it. With the combination of commissions going to zero, okay, Robinhood, COVID, people at home, everything we saw. I mean, it was limited to a certain number of stocks, but it really did highlight this question of shorting. So, I mean, I still think that there are a lot of question marks around the business of fundamental shorting. I'm not saying it's dead or it's over by any means. I mean, I think there's and there's less people doing single stock. There's more people doing ETFs, so it's possible that there's a fine opportunity set because less people are doing it. But I do think that if you look at funds that produced a lot of short alpha, which isn't that common, by the way, if you look at funds that produce a lot of short alpha, they often did. I mean, the best stocks to short were the heavily shorted stocks. That's
exactly right.
And so they made a lot of money doing that. No one's really going to be willing to do that anymore. Now, if 40% of the float is short, 50%, they're like, all right, I got to move on to another one. I have to find something else. They used to short that and make a lot of money. So I do think there's, number one, there's a big question mark around short. We're spending a lot of time on that, trying to figure out, again, there's less people doing it. So I'm not trying to call the death of shorting by any means. I think that actually could be a very rich, based on where sort of valuations are today, it seems like there should be opportunity, should have potential for some choppy markets, but that's one big question. And the other one in terms of what we're looking at is over the past, this isn't really COVID related, but just as this kind of relates to quants and everything else that's happened in the US, finding managers that are producing real alpha in market neutral strategies, it has become hard. Or the alpha, it's there, it's just shrunk. Whereas in Asia, we're able to find managers who are market neutral, dollar neutral. And when I say market neutral, I actually mean dollar neutral. I'm not a big believer in beta, so I like measuring beta. So I mean like really dollar neutral. We're finding managers in Asia who dollar neutral. They're not fully factor hedged, but they're factor constrained, who are making sometimes double-digit returns out, but that's very hard to find in the developed markets. So I do think Asia, with all the risks that we've seen from China this summer and Asia, which there are risks there, you are getting paid. It's one of the few areas where market neutral seems to be able to actually make money.
Okay, John, what are you looking at?
Well, I very much agree with Ram's point on Asia and the long short opportunity set there. I think as you talk to managers and hear about the opportunity set, you hear about one thing, especially in the equity space, over and over and over again, which is the amount of retail capital that is active in China, especially, creates an extraordinary opportunity for institutional investors who are kind of better at identifying patterns and systematically mining the active return that's to be made in the long short space. Significantly higher than in developed markets, probably something closer to what it would have been like in the US in the early 1990s, different world. And so the opportunity set is quite rich for long short strategies in Asia and emerging Asia and China specifically. I know, the word uninvestable is a popular one to debate these days around China, and without taking a strong position on the very good reasons people have to have that debate. And of course, there are the governance issues and the regulatory issues. Hedge fund capital is there to stay in China. Most managers, I think, that we look seriously at are dedicated to that mandate. And so the long short world in China is going to continue. And not only is investable, but the return premium, even accounting for the governance and regulatory issues, is quite significant. Very, very quickly, I did want to add to one other thing that Ram said as well, and he was talking about January and the short squeezes that we've seen in certain air pockets, if you will, this year especially. For this notion of call them crowded trades on a bad day or widely held trades on a good day, hedge fund quote crowding has gotten quite significant. It's gotten over the long run and in the short run, it's gotten even more so, partly because those widely held, quote crowded trades did so well last year when there was just kind of one or two major return drivers that caused a lot of piling in. As a consequence, though, when you get those air pockets, be it like January, be it like a Ford GM 2005 for you convert R buffs, or 2011, there's a significant potential to be on the other side of that trade if you can actually find managers who, which is a very small percentage, that are able to exploit that unwind of the rest of the hedge fund universe's crowded trades. Like I said, not simple to find, but really potentially hugely additive for a portfolio if you can find strategies like that. And so a lot of the compelling opportunities are, whether implicitly or explicitly, targeting that opportunity.
Okay, no, thanks, John. Thanks, John. I mean, we've got a bit of time left here. I mean, in terms of final sort of question and to explore is around, we've been talking about alpha and beta and systematic trading and long short, etc. I mean, in terms of sort of where do we see the sort of the quant versus the fundamental kind of product of the future, shall we say, given the topics here for the panel? I mean, is there still a role for fundamental investing? Anne-Marie?
Yeah, there still is a role. It's though I would say we do actually, Quant's actually been having a tougher time of late, and so we're actually leaning into it a little bit. But for sure, I think we'll always have a portfolio that's got both. Because if you find good managers, they can make good managers in the quant space can make money. Good managers in the fundamental space can make money, and we like the variety of. They tend to make money at slightly different times, so we like the variety and the diversification that we get.
I mean, have you seen? I mean, in my company, we handle a lot of big data because we invest in physical commodity trades, and there's like hundreds of pages of documentation to move physical cargoes around. It's not like taking a terminal and clicking and buying certain equities. It's like a whole different ballgame. So have you seen much impact of big data also impacting how strategies are developing?
Yeah, for sure. I would say the pure quants are, they probably have just as many people cleaning data and working on their data sets as they have trying to create models, if not more, actually working on the data sets. So we're definitely seeing a lot of focus there. And I would say even among our more fundamental kind of traditional, if you will, managers, they're all incorporating systems and data into the way they do it now. It's not quite as algorithmic, but they're definitely focused on data and finding ways to more incorporate it. And I think actually it's starting to become a little bit of shades of gray, right? So our fundamental people are using data, but they're people plus data, and our quants are using people but plus data, so it's data plus.
Right.
So it's becoming much more of a spectrum, and the ability to utilize data, I think, is to effectively utilize data, particularly now when we're all drowning in too much data, but to effectively identify the interesting and market-moving pieces of data. I think everybody's working on that, and it's just slightly different approaches.
That's great. Thank you so much. We're sort of in the final countdown here before, well, not liftoff, but cutoff. Rom, anything to add there in terms of the fundamentals versus the quants?
I think there is, as Anne-Marie said, things are becoming a little more quantamental. I mean, there aren't that many people.
Quantamental, okay.
They're becoming quantamental. And there is a little bit of an arms race when it comes to data too, in the sense that a fundamental manager that 10 years ago was paying for credit card data and trucking data was somewhat differentiated. Now they're sort of all doing it. You sort of have to be paying for some of these data sets just to keep your head above water. So I'm not saying everyone's doing it, but I do think it's much more common now for purely fundamental managers who build models and DCFs and all that sort of stuff and go kick tires to also be buying a lot of data sets.
I think, John.
Yeah, I think since pandemic, prior to pandemic, I think that the story that quants are just eating away at the fundamental alpha and would continue to do so was really strong. And then as it happened, the pandemic really, and the data disruption really upended a lot of quant models. And as a result, quant generally, as Anne-Marie mentioned, has been underperforming in the most recent window, but a lot of capital has left the space. And to me, that creates very significant opportunities for the return that's able to be generated from those quant strategies.
Well, thank you. Thank you so much. We're out of time now, but thank you so much indeed to all of you for a very interesting conversation. That 40 minutes just zoomed past. We could probably talk for hours here. Thank you, Anne-Marie, Ron, John. Thanks for your time today. Very interesting.